You anticipate interviewing for an internship or full time position in investment banking, equity research, or other competitive fields in finance? One of the questions you're likely to see is walk me through the three financial statements. This question is usually one of the first technical questions asked in many interviews, and it can really set the tone for the rest of the interview depending on how you answer it. In this video, we will walk through two parts. The first is a conceptual review of the topic. We'll walk you through the basics of the three statements and how they interact together. We'll do this primarily using the three statement financial model that participants build in our Financial Modeling Certification Program, or FMC program. The second part of this video will be to walk you through some tips on how to answer this question in an interview setting. Having a solid understanding of the topic at hand and successfully answering the question in an interview are related, but they're not necessarily the same thing. The three financial statements, the balance sheet, income statement, and cash flow statement, each offer unique details with information that is all interconnected. Together, the three statements give a comprehensive portrayal of the company's operating activities. The statements are reviewed by management, investors, lenders, and other stakeholders for the purpose of assessing the company's financial position. Starting with the income statement, this statement presents the results of operations over a period of time, typically a month, quarter, or year. The income statement provides details on the revenue a company earns and the expenses involved in its operating activities. The subtraction of all expenses results in the bottom line net income or total amount of profit a company has achieved. The balance sheet shows an organization's financial position at a point in time and is broken out into three sections: the company's assets, liabilities, and shareholders' equity. An asset is any resource owned by a business that can be utilized to produce value. A liability is defined as a company's financial obligations, like the money a business owes its suppliers or creditors. Equity represents the shareholder's stake in the company. In order for the balance sheet to balance, assets must equal liabilities plus equity. The cash flow statement provides a view of a company's overall liquidity by showing cash transaction activities. It reports all cash inflows and outflows over the course of an accounting period with a summation of the total cash available. Standard cash flow statements will be broken into three parts: operating, investing, and financing. This financial statement highlights the net increase and decrease in total cash in each of these three areas. Cash from operating activities is the amount of cash generated by an organization's normal business operations. Most common line items included in cash from operating activities are net earnings, depreciation and amortization, and change in working capital. Cash from investing activities is cash flow related to the acquisition and disposal of an organization's long term investments, including plant, property, and equipment, and mergers and acquisitions. The most common line items included in cash from investing activities are capital expenditures and acquisitions. Cash from financing activities is cash flow between an organization and its owners and creditors. The most common line items included in cash from financing activities are debt and equity issuances and repayments, dividends, and share repurchases. A great way to conceptualize and explain these concepts is to review a three statement financial model. This particular model is from our Financial Modeling Certification Program, which requires you to build a three statement, 8 tab financial model in under 90 minutes with less than 10 formatting errors and minimal formula errors. Now, we're going to walk you through the three financial statements and how they interact with each other by using this financial model. The income statement is a summary of a company's revenue and expenses over a period of time, in this instance, a year. In this model here, we have 3 years of historical statements and 5 years of forecasted statements. Years 1 through 3A represent the historical period, and years 4 through 8E represent the forecasted period. So, to walk through this income statement, let's begin with revenue. Then we subtract out our operating expenses. These expenses can represent items such as costs of goods sold, SG&A, and depreciation to name a few. Then we subtract out our interest expense. This accounts for any interest that we need to pay for short or long-term debt. We represent interest income as a negative because when we subtract it, it will become a positive. Interest income is the interest that the company has earned from its cash balance in the bank, accruing interest. Then we account for any other expenses or income. Then, after subtracting out total other expenses, we get to our earnings before taxes. From here, we take the corporate tax rate to calculate the taxes that the business owes, and then we subtract them from earnings before taxes, and we get our final net earnings or net income number for the year. Now, we're going to go through the cash flow statement. The cash flow statement, like the income statement, is over a period of time. It shows the inflows and outflows of cash broken down into operating, investing, and financing activities. In financial models, the cash flow statement is typically only for forecasted years, in this case, 5 years. As you can see, net income is the top line of the cash flow statement. This is the link from the income statement to the cash flow statement. Net income is typically accrual based, which means it's accrual profit, not necessarily cash. So there's typically a handful of changes on the cash flow statement that reconcile net income with the actual change in cash. Let's begin to walk through the line items and sections of the cash flow statement. Beginning with the operating activities, this section indicates the amount of money a company brings in from its ongoing regular business activities, such as manufacturing and selling goods or providing a service to customers. We start with net earnings and then add back our depreciation expense, which is a non cash expense. And since there was no true outflow of cash on the income statement, it helps reduce our taxable income. However, we need to add it back to represent that no cash has truly left the company. Then we account for the change in working capital, which is the difference between a company's current assets and current liabilities. If assets increase by more than liabilities, this is negative, otherwise, it's positive. Moving down to the investing activities section, this section represents purchases of physical assets, investments in securities, or the sale of securities or assets. Here we subtract our capital expenditures, which is an outflow of cash to purchase fixed assets that have a useful life of over 1 year. Think of a machine, for example. Lastly, we move down to financing activities, and this section provides investors with insight into a company's financial strength and how well a company's capital structure is managed. Here we subtract out the dividends we paid to shareholders, as well as subtract out the shares the company repurchased because that represents an outflow of cash. Then we account for the changes in our revolver, which is a line of short term debt that almost acts like a credit card, and our long term debt. These will be positive if we take on more debt because that would represent an inflow of cash, or they will be negative if we paid a portion of our debt because that represents an outflow of cash. Then we add together all sections for the year to get our change in cash. To calculate our ending cash balance for the year, we add together our beginning cash balance and our change in cash. Now we're going to go through the balance sheet. The balance sheet is a snapshot of a company's financial position at a point in time. It shows the assets, liabilities, and shareholders' equity balances, in this case on the last day in the calendar year. In this case, we have 3 years of historical statements and 5 years of forecasted statements, just like the income statement. Note how cash for each year comes from the cash flow statement. This is the common link between the cash flow statement and the balance sheet. We then have our other assets. Current assets are used in standard business operations over a 1 year period or less, and long term assets will be used beyond a 1 year period. Accounts receivable and other current assets are linked to the cash flow statement through the change in working capital line item. Net PP&E, or property, plant, and equipment, is also linked to the cash flow statement, as this line encompasses any spending on capital expenditures in the investing activities, as well as subtracting out depreciation from the operating section. Moving down to liabilities, similarly to what we said about the lifespan of current and long term assets, the same stands true for current and long term liabilities. All of our current liabilities, accounts payable, accrued liabilities, and other current liabilities, are linked to the cash flow statement through the change in working capital. Total long term debt is tied to the financing activities on the cash flow statement. So if debt was issued, this would increase and vice versa. Last but not least, we have shareholders' equity, which is a common link between the cash flow statement and balance sheet. Because net earnings minus any dividends, minus any shares repurchased from the cash flow statement, flows into the shareholders' equity account on the balance sheet. Note how the balance sheet always balances with assets equaling liabilities plus equity. Given the fact that we just went through a conceptual review as well as an Excel walkthrough, you're probably feeling comfortable with the three statements. However, be cautious that just knowing the concept or answer isn't always enough, and there's a gap between knowledge and actually answering the question well. You'll need to practice this concept and walk through the three statements numerous times before it's interview ready. While there is not one specific way to answer this question, I'm going to share a version that you can potentially answer this question with in an interview. However, be aware that there isn't just one way to answer this question, and you can deviate from this approach if needed. The income statement is over a period of time, typically a quarter or a year, and shows a company's revenue, expenses, and results in net income. The cash flow statement is also over a period of time, typically a quarter or a year, and it starts with net income and shows sources and uses of cash, organized into operating activities, investing activities, and financing activities to arrive at an ending cash balance. The balance sheet shows a snapshot of a company at a point in time with three different groupings: assets, which are equal to liabilities plus shareholders' equity. Ending cash on the cash flow statement is always the same as cash on the balance sheet. You don't want to put yourself out on a limb, and you also don't want to bore the interviewer to the extent that they want to move on to a different topic or question. You should be ready to dive into much more detail, but also be thoughtful around using time wisely and letting them guide you into how much detail they want to